All right, hello again, everybody. I've pre-recorded this for your review at your convenience. So today we're going to talk about Chapter 6, a couple of main topics here. I'm going to deal with cash and accounts receivable, also deal with bad debt, and the third major topic is reconciling the bank account. And that's the one thing I said at the beginning of the class. If you learn nothing else, you'll at least know how to balance your checkbook. So we'll do that towards the end today. All right, so let's go ahead and get started. The one thing you should probably do first is you might want to pause this and then go ahead and open up the notes from our Canvas web page, the notes for Chapter 6. There's 3 handouts I'm going to take a look at. So you might want to go ahead and open those now. That way you'll be ready. So anyway, let's get started talking about sales and accounts receivable. The first handout I have kind of goes over some of the basic topics. I'm not going to take a lot of time to give, basic definitions here, but I'll go over the highlights. So the thing is, when we talk about accounts receivable, or you've heard the term sales on account or sales on open account. So yeah, that's when we allow our customers to pay later. So we send them an invoice, or if we're the customer, we're receiving the invoice. So from the seller standpoint, it's called a sales invoice. From the buyer standpoint, it's a purchase invoice. Okay. And more on that in a second. There's some secret codes you have to know about that help us determine how much to pay and when to pay it. But that's basic accounts receivable. We're also going to talk a little bit about credit card sales, just briefly, to how we account for that. Okay. Now, the chapter kind of starts off basically telling us on, well, how are you going to report sales? So here on the handout, I've got a hypothetical example. Gross sales were 10,000 for the month. Okay. But then we have to report what we call returns and allowances. So a return's a refund. So you go into Walmart up here in Roanoke Park and you make a sharp left. What's the first thing you run into? Besides McDonald's and the restrooms, you run into the customer service area, and there's usually a long line of people returning things, right? So we don't want to just subtract those from sales directly. We want to keep track of them separately. So we're going to set this returns and allowances account up as another contra account. So sales normally has a credit balance, right? So we'll keep that. So the sales returns and allowances deal is going to have a debit balance. Okay. And when we say allowances, it's like a partial refund. For instance, well, like in the old days when you went to Sears, you're looking for a new refrigerator and they tell you, hey, we have this one floor model that has a dent in the side. We'll give you an extra $100 off. And you don't care because the dent's going to be facing a wall, right? So that's what they mean by an allowance. So it's like a partial refund. Okay, so we're going to report those, or internally we'll record those separately. Externally, we're just going to report the net amount. Similar discounts, there's a contra account for that, carries a debit balance. We're going to talk about 2 slightly different types of discounts. One's a trade discount and one's a cash discount. Okay, so primarily we'll talk about the so-called sales discount or cash discount. And I'm going to jump down a little bit. So if you flip over a couple of pages in the book to page 291, they've got these little secret codes down at the bottom here. So I'll try to move my camera here so you can see that, and then I'll go back to the handout here. There we go. That's better. Okay, so what the heck are they talking about here? So again, when we sell something, we on accounts receivable, debit, AR, credit, sales, but we have to tell our customer, when they have to pay it. And in fact, a lot of times we're going to give them an incentive to pay early, okay, because we want to get our cash flow going. All right, so there's this little secret code that we put on the invoice. this 2/10, N/30. So what this means is we're offering the customer a 2% discount if they pay it within 10 days from the date of the invoice, okay? So you can take a 2% discount if you pay it within 10 days from date of the invoice, comma means otherwise. Okay, so if you don't take the discount, then just pay, the N means net amount in 30 days. And net in this case means it's gross sales, but less any returns, okay? So basically, take the 2% within 10 days, otherwise just pay us the full amount in 30 days, okay? Now, do sometimes people take the discount after 11 or 12 days? Yes, that happens. So it kind of depends on your company policy, whether you're gonna try to charge them back for taking the discount after 10 days, but usually most companies will allow a couple days slack for mailing time, that sort of thing. There are several variations of this. I'm going to go back to the handout for a second and note a couple of them. So here's our 210 in 30. But another one, let's say you don't take the 2%, but okay, well, we'll give you a 1% in 15 days. Okay, 210, 150, comma, N/30. Okay, so you can take a 2% discount within 10 days from the date of the invoice. If you don't do that, we'll still give you a 1% discount if you pay within 15 days. If you don't do that, then yes, please send us a check within 30 days. Okay. All right. There are several other variations of that. A lot of times you'll just see a straight N/30, straight N/60. There's another one called the receipt of goods, ROG, I should say. So ROG, receipt of goods. We don't cover that in this textbook. There's also another variation called end of month. If you take our practical business math class, BGN 81, we'll cover some of these other technical issues in there. But as far as this class goes, just focus on the 210 N/30, or you might see a 115 N/30, something like that. So that's the secret code. Other thing I'll mention briefly is, of course, the invoice has to include all the usual info of the item being shipped, the the price, the quantity, all that sort of thing, but also the shipping terms. Who's paying for shipping? Because that becomes critically important. The general rule is the person that's paying for the shipping is the party that's responsible for it during shipment, in case the truck jackknifes on I-80 and spills half the load all over the freeway, or something gets stolen from the truck, or the truck catches on fire, or the boat sinks, or the train derails, or whatever. So that's something that you will commonly see on invoices, are the shipping terms as well. Okay. All right. Enough said on that. This gross profit stuff, that's actually from chapter 5, but sometimes textbooks change which chapters they put stuff in. So this is a little outdated, but you'll of course use that from previous chapters. All right, let's see. The other thing I want to mention related to these discounts is they do show you in the back of the chapter, there's a chapter supplement. So I'm going to flip over to that real quick. And that starts on page 313. So I'm going to flip over to that. Okay, so page 313. What if we sell stuff using and accepting credit cards? Okay, well, if we're accepting credit cards, the credit card company charges us a fee to do that. In addition to the outrageous interest charge that they charge to the customer's account, they charge us a service charge for using the credit card. Of course, that makes sense because we're transferring the risk of non-payment to them. Okay, so we have to pay a fee to do that. So they have to handle all the collections and they bear the risk of loss. Okay, so in this particular example, the credit card company is charging a 3% merchant fee. okay, on sales of 3,000. So you take, 0.03 times 3,000, you get $90. So typically you'll get paid overnight. So you'll just record this as basically that you're receiving cash, but you have to record the net amount of the cash you're receiving. So in this case, we credited our sales for 3,000, but we're only going to receive 29.10 in cash. So we'll debit cash 29.10, and then we have to plug the $90 into this account, credit card discount, another contra revenue account. So that's what I meant in this early example here. That's one type of discount there. So credit card discount, you will see other terms from time to time, depending where you're working. Merchant fees discount, credit card service fee, merchant discount fee. It goes by a number of different names, okay? But that's the fee that we have to pay to the credit card company in order to accept credit cards and transfer the collection process and the risk of loss to them, okay? All right, now on the next page, they show you our 210 in 30 scenario, okay? So how are we gonna deal with that up here? So it's kind of a two-step process. When we initially offer the customer a 2% discount, well, we don't know if they're going to take it, right? So on the date that we make the sale, we're going to record our sale, assuming we've delivered the goods, right? So in this case, it's $1,000, transactions for $1,000, and there's a 2% discount involved. So we don't know if they're going to take it or not. So debit AR for the full 1,000, and then credit your sales account for the full 1,000. Now, when the discount period rolls around and they do in fact pay us, then we have to account for that discount, okay? We still credit the customer's account for $1,000. In this case, they only sent us the check for $980, okay? Because they did take the discount. So we have to plug that $20 fee or discount that we've offered into the sales discount account, okay? Often called cash discounts. Yeah, so that's another contra revenue account, carries a debit balance, as you can see there. One other note, they have this in a little tiny footnote somewhere. I forget which page it's on, but there's something called a trade discount. Trade discount is just a discount from the MSRP. So it's kind of like if you think of a new car sales, the sticker on the window, that's like the MSRP, and hardly anybody ever actually pays that amount, right? So similar situation, like say for instance, Santa Rosa JC, buys a bunch of these calculators from Office Depot, and let's say the list price is $10 each. But because we're a large customer and we're buying, say, 100 of these calculators all at once, they offer us a discount off the MSRP. So basically something like, 10, 15% off the list price of all the office supplies that we buy from Office Depot. We get a discount rate because we're a major customer, we buy lots and that sort of thing. So in that particular case, we initially record that net amount because we assume everyone's always going to take the lower amount. No one's going to pay the full list price when they're automatically being offered a discounted price, regardless of when they pay the bill, okay? So that's a trade discount, and we're talking about cash discounts in the numerical transactions we're showing you here. Let's see. Yeah, oh, here's how they show you the sales returns and allowances. So again, just going to reduce our total net sales figure. Okay, but here they said, okay, we, Skechers bought or sold, let's see. Yeah, Skechers sold $2,000 worth of shoes to Dick's Sporting Goods. So they're debiting AR and crediting sales revenue. But then later, Dick's returns some of the shoes, okay? So debit sales returns allowances and credit AR. Now, I want to reemphasize or emphasize again why we want to record sales returns allowances separately as a contra revenue account. If we didn't keep track of them separately, we wouldn't know roughly what the percentage of returns we're going to experience. So in other words, the Walmart example I gave earlier, using a sales returns allowances discount, they can compare that to the gross sales and come up with a percentage. So in my example here, it would be 7%. So they have to, they have to account for that when they price their merchandise, right? Otherwise, they would soon be out of business if they didn't account for it, what their average level of returns is. So that's an important concept there. Having said that, I won't go into it in more detail. It's fairly basic, okay? Sales on account, accounts receivable, sales on open account, that sort of thing. Couple of ratios to take a quick look at. This is on page 303. And these are on the bottom of the handout. Receivables turnover and average collection period. Notice I've squeezed in also known, AKA, also known as average days sales in accounts receivable, okay? So up here on the top half of the page, well, what's this receivables turnover thing? Well, the math is pretty straightforward. Just take your net sales figure and then divide that by the average of your net trade accounts receivable, okay? And we say trade accounts receivable because sometimes companies have other miscellaneous receivables, like from employees or corporate officers, that sort of thing. So you'll see some other types of receivables, but we're talking about your basic accounts receivable that's dealing with your customers here. And again, the average, well, how are we going to get that? It's just a simple average like we've seen in a number of other ratios at this point in time. Just take the beginning, the ending, divide it by 2. That's how you're going to get the average, okay? So, so here's their net sales, 4,164,000 and change there. So this gives me a figure of 11.4. Well, so what? Big deal. What does that mean? You know, I can do math. Yes. What does the 11.4 mean? Well, there's 12 months in a year, right? So we're collecting them slightly less than 12 times a year. Okay. So that's what that means. And even that, that's not super informative. You know, until you've looked at it a few times and maybe compare it to yourself over time, compare it to competitors. But look a little further down the page. Again, I penciled in average days sales and accounts receivable. So basically take 365 and divide it by 11.4 and you get 32 days, okay? So that's a little more informative. So yeah, on average, it takes this company 32 days to collect their accounts receivable in full, you know, ignoring bad debt for the moment, but you know, their net accounts receivable, okay? So now if their terms are net 30, that's pretty good because almost everybody pays on time or just slightly late. If your terms are net 10, this isn't so red hot, right? So you can't make a decision on a company just based on the number. You have to kind of know some of the background information. The other thing you'll notice I've penciled in that, you know, this ties in with the average days sales and accounts receivable. So the somewhat of a shortcut, I guess you could call it, just take your average accounts receivable, you know, calculated the same old way. And then divide that by your average sales per day. You know, take your annual net sales and divide that by 365. So you come up with the sales per day. Okay, so then just take your average AR divided your average sales per day, and you'll come up with the same thing, except for maybe some slight rounding or something. Okay. So those are a couple of things you want to make sure you understand, have in your notes, et cetera, before you take the quiz or exam. All right. Let's see. Oh, you know, do read through these cash flow things. This is on page 304. I don't take a lot of time to cover them in each chapter, but they do give some explanations. We'll go into the cash flow statement in detail on in chapter 12 when we cover that almost at the end of the semester. Okay. So, but do read through them. It's kind of weird. You know, we take our basically we have to adjust net income for changes in our current assets and current liabilities. So it says add accounts receivable decrease or subtract accounts receivable increase, which sounds like it's the opposite of what it should be, but it's not. And I'll explain that in further detail. They do give you, some math down here, but take a minute and read through it. But I'm not going to give you some big cash flow question on the exam. Other than those definitions we've talked about previously, the three main categories, cash flow from operations, cash flow from investing activities, and cash flow from financing activities. So focus on those definitions for now. Okay. All right. So I'm not going to take the time to do any particular exercise with this topic because I think that's pretty straightforward. The next topic is bad debt expense. Okay. So let's think about this for a minute. Okay, so page, well, it starts at the very bottom at 296, but the real meat and potatoes is on 297. And why did my screen go blank? There we go. Hopefully your screen didn't go blank, but mine did. Okay. All right. So on 297, some definitions here at the top. Again, they tend to put the key definitions out in the right-hand margin in addition to the paragraph. So I think that's pretty helpful. So when we talk about bad debt expense, it does go by a couple of other names. Doubtful accounts expense, uncollectible accounts expense, provision for uncollectible accounts. Those are all the expense items that's gonna, we're gonna be debiting on our income statement. This thing called the allowance method, there's a contra account called the allowance for doubtful accounts. Now, I'll take a little side detour here for just a second and mention some companies use what they call the direct write-off method. And that's usually only typically real small companies that technically don't have to report their financials on a GAAP basis. Okay, so just as something comes, they identify account as uncollectible, they just do a write-off. So that's not GAAP. So we're talking about the allowance method, okay, which means we have to make some sort of an estimate for the amount of accounts receivable that we know we're not going to collect based on our historical average for our company. Okay, because if we didn't make some sort of estimate when we report our accounts receivable at the gross number, we'd be overstating that asset, right? Because we know, typically there's no way we're going to receive 100 cents on the dollar. With some couple of minor exceptions I'll mention briefly. One is you don't have to worry about bad debt if you're the mafia, right? Because they'll make you pay one way or the other. They always get paid. Might make the customer walk with a limp, shoot off a kneecap or something, but they'll always get paid. And another one, kind of interesting, a friend of mine has a CPA firm down in San Diego, and he was telling me a few years back, hey, I have this client. The client runs this little German car repair place. It's like, factory trained technicians. It's not the dealer, but it's, a factory authorized repair for Mercedes, BMW, Volkswagen, those sorts of things. Anyway, he tells me, yeah, I was talking to my client at the end of the year. He says, I noticed you have some accounts receivable on your books. So let's set up an estimate of your bad debt. And the guy says, well, I don't have any bad debt. And the thing you need to know is the guy is like this huge guy, really mean looking, and he's actually done hard time in the pen. So the guy tells my friend, says, hey, somebody owes me money. I don't get paid. I just go knock on their door and say, I want my money. I always get paid. So he and the mafia don't have to worry about bad debt, but the rest of us do. And there's two main ways to make this estimate. One is the percentage of sales method. Technically, it's the percentage of credit sales, credit meaning AR, okay? And the other one's the aging method. And both of them use this allowance deal, okay? So what I'm gonna do is start with the simpler of the two. It's just a percentage of sales, okay, or percentage of credit sales. So in this example, I'm saying, okay, so we have $10,000, okay, of accounts receivable, okay, but we know based on history that we're not going to get paid for 4% of those, okay? So we're going to have this we're going to have to record $400 worth of bad debt expense, okay? So debit the bad debt or uncollectible accounts expense, whatever it's being called, for 400, and credit this weird thing, this new account called the allowance for doubtful accounts for 400. So again, it's a contra account. Well, normally, why is it contra? Normally accounts receivable carries a debit balance, right? It's an asset, so normally it's going to carry a debit balance. Well, this is a credit amount, okay? So it's a contra account because we're crediting this allowance, okay? So we're setting up something like a reserve, if you will, okay, just on the books. So we're setting up on paper or book some reserve because we know we're not going to get paid on average 4%. We just don't know who's not going to pay us, okay? So then later, we identify an account. So we've sent the customer, the original invoice, the next invoice, the late notice, the second late notice. We've called them, and they've told us basically something slightly less polite than take a long walk on a short pier, right? So we know we're not going to get paid. So we're going to have to write this account off. Okay, so pretty straightforward. Remember, we set up this allowance. Well, that's what we're going to debit. So we're just take it out of the allowance. So we're, in this example, $25 debit balance or account that we're writing off for 25 bucks. Okay, so debit the allowance and credit accounts receivable. Okay, and again, there's no cash involved. The common mistake that I'll see is students want to debit bad debt expense again, which you'd be double counting it because you've already estimated it up here. Or sometimes I'll see students debit cash. No, we're doing this because you're not receiving the cash. So don't debit cash, don't credit cash either, because there's no cash involved when we do this write-off, okay? So don't make the mistake of recording cash somewhere, and don't record bad debt expense again. Take it out of the allowance, okay? That's the whole purpose of setting up the allowance, okay? Let's see. The other thing I mentioned must be posted to the accounts receivable subsidiary ledger. Yeah. So when we have accounts receivable on our general ledger, that's a roll up of each individual customer's account, right? So if you're, Sears or let's say Walmart. Well, Sears used to, you could get a Sears charge card, which basically is just a little plastic card saying that you have an account with them. It's their accounts receivable. So, so lost my train of thought there. Anyway, that's the disadvantage of getting old. You can't always remember what you're going to say. Anyway, so AR subsidiary ledger. So all of those have to get, all the individual customer accounts are rolled up into the main account that you see accounts receivable on the general ledger, okay? People are going to accuse me of being like Joe Biden here pretty soon. So let me take a minute and put some T accounts down for you here, because I think this will help clarify what's going on. And they do point this out in the book. But I'll give you a little example here. Let's see. Let's see. I'll have A/R accounts receivable, and then the allowance for, DA, allowance for doubtful accounts, and then I'll have bad debt expense. Bad debt expense. Okay, so in my example here, we're going to start off with 10,000 in AR because we've already recorded that. So, you know, I didn't put the sales account down here, but when we recorded this, we debited AR and credited sales for 10,000. Okay, now transaction A here says, okay, well, we've identified 4%. So we're going to lose $400. Okay, so I'm going to debit bad debt expense 400. That's transaction A. And I'm going to credit, I'm not going to credit AR directly. I'm going to credit this allowance thing to establish our reserve. Okay. So that's A. And then let me show you the net accounts receivable. Okay. After transaction A. So we've got AR at 10,000 less the allowance for 400. Okay. So my net AR is 9,600. Okay, so you might want to run across a question. You know, what was the what was the balance? You know, what's the net balance of accounts receivable? Or they might ask you to even work backwards. They'll give you these numbers and say what was the gross amount of accounts receivable, something like that. So, and there is an example in the book, so make sure you take time to read through that. Now, here's the thing that kind of blows people's minds. So after transaction A, we said, okay, we've got a net AR of 9,600. Now, what happens? Transaction B, entry to record or write off for $25. So we're going to debit the allowance for 25. Now we're going to credit accounts receivable directly for 25 because we've identified a particular account, okay, that we know we're not going to collect. And you know, so we're going into the subsidiary ledger to the account of I'm a deadbeat and crediting his account for $25 and then making a note in our system that this person's not allowed to buy on credit anymore. They're cash only. Okay, so let's see. Now I've got a balance here in AR, 99.75, right? 99.75. Now I've got a balance in the allowance of 375. Okay. Well, 99.75 minus the allowance of 375, 9,600. Okay. So the net accounts receivable is the same both before and after the write-off. Okay. So that's, oh, let me get up here. Sorry about that. Yeah. So you can see here, we had a $9,600 balance before the write-off, and we have a $9,600 balance after the write-off. Okay. So again, you will see questions that ask you to back into one of these numbers. So, you know it forwards and backwards, like I always say. Okay. All right. Let's take a look at, yeah. All right. Let me just double check something here real quick. I had something in mind here. Yeah. Okay. Yeah. So that's, yeah, I have to come back. So we're going to do exercise 6-13 in a minute. But before we do that, there's another method of accounting for bad debt expense. Okay. And it's called the aging method. And that is on page, let's see, what the heck. Oh, here we go. Yeah, a couple pages over. Page 301. So that's one method. So the percentage of credit sales is one method. The other slightly smarter method, a little more involved, is the aging method. In other words, we're not just going to apply one straight percentage to all of our accounts receivable. We're going to be a little bit smarter and say, well, the older it gets, the less likely you are to collect it. Okay. So that's what they're showing you here. Set it up like a spreadsheet. Okay, set it up like a spreadsheet. They're saying, well, the stuff that's not even due yet, typically we only experience a 2% loss on that. So they're breaking down the total accounts receivable based on how old, and they set up these categories. Not yet due. Well, we'll only lose 2%. So we do the math and estimate that we'll lose $4,600. Okay. Now, up to 90 days past due. Well, we're going to lose a substantial percentage of those, 12%. So we just do the math, okay? And then in this particular example, anything over 90 days past due, we're probably going to lose 30% of that. So we just do the math here. So set it up like a spreadsheet, do the math, multiply it out. You get 48,760, okay? Now, here's the hook. That's the amount that you want to end up with as the ending balance in your allowance account, okay? So you have to work backwards and plug bad debt expense, okay? So it depends what's already in there. So in this particular example, they already had 51,180 as the beginning balance. And there's already, and we record write-offs of 17,420, but we need an ending balance, okay? So we have to plug the difference. So the bad debt expense becomes $15,000, okay? And that's the amount that we will record as our journal entry, okay? So again, let's see, comparison of the two methods, yeah, whatever. So you can read through that. But yeah, so the thing that confuses students is a lot of times students will think that this is the entry they're supposed to make, the 48,760, you know, debit bad debt expense, credit the allowance. That's not what you're going to do. This gives you, again, this gives you the ending balance you want, okay? So you have to plug the difference. So it's debit, in this case, debit bad debt expense for 15,000 and credit the allowance for 15,000, okay? So do play with those numbers. Again, you might get a question that gives you just enough information to work backwards and figure out what was the beginning balance, okay? All right, let's take a quick look. Like I started to a minute ago, exercise 6-13. So I'll get a piece of scratch paper here. So like I said, we'll just set it up as, you know, a spreadsheet basically. So let me do this. Grab my sheet of paper here. Okay, so 6-13, this is on page 322. So we'll go through and pick out the relevant numbers here. Not yet due, 22,000. So I'm going to do the math here, 22,000. And up to 120 days past due, 6,500, and then 2,800. So 6,500 and 2,800. Whoops, move that over. 2,800. And then they give us the percentages to apply to each category, right? So let's see. So they tell us the first category is 3%, so I'll say 0.03. And then the next two categories are 14 and 34%. Okay, 0.14 and 0.34. Okay, so we'll just multiply those out and get what we think should be our ending balance. Okay, so yeah, so 3, 14, and 34. Okay, so I'll do a little quick math here. Whoops, helps if you enter the correct number. 22,000 times 0.03 equals 660. That's what I was getting in my head, but it's always pays to do it on your calculator just in case. 6,500 times 0.14 I'm getting 910 and 2800 times 0.34 equals 952. 952. Okay, so we got a 2 here. 7 and 5 is 12. 7, 9 is 16, and 9 is 25. So I'm getting 2522. That's the ending balance that we want in our allowance account, okay? But there's a little bit of a hook because there's already a balance in there. At the end of the current year, the allowance for doubtful accounts balance is $1,200. So they're just telling us it's a $1,200 credit balance. So that's what's in the allowance. But we want the ending to be 2522. Okay. So this is the allowance. Okay. And by the way, this is at the end of the period, right? After they've recorded, you know, all their previous write-offs and that sort of thing. Okay, so this is the balance we want, and this is the balance they gave us that's in there already after recording sales for the period and write-offs and all that sort of thing. Okay, so it looks like, you know, we need another 1322. Okay, because here's our ending balance that we want, and here's the beginning balance. Okay, again, after write-offs and all that sort of thing. Okay, so our entry is going to be a debit to bad debt expense and a credit to the allowance account for 1322. Okay, so do practice those. I don't think you'll have too much trouble with it, but again, a lot of students do want to pick this number up as the bad debt expense number, but that's not correct. Okay, it's the difference. Oh, the other thing is, if they said it was, let's say it was like a $200 debit balance. In other words, if there's a debit balance in the allowance account, that means they wrote off more than they allowed for. Okay, so if there was a $200 debit balance, I'd have to add it. I'd have 2522 plus 200. My entry would be for 2722. Okay, so that's a big difference there. So make sure you understand that. You do sometimes run across a problem that says it's a debit balance in the allowance account, but most of them it's a credit balance. Okay, but just keep an eye out for that. All right, so that's bad debt expense. Let me just take a moment here and check my notes, make sure I'm covering everything I want to cover so far. Let's see. Oh, I'm going to mention one thing briefly on page 292 that I want you to read through, but I'm not going to, I doubt I'll have any questions on it, maybe one. Dealing with discounts, early payment discounts, if I'm the buyer, it's like, well, should I take the discount or should I not? Okay, so you might run across a question on this. Well, they're giving you a 2% discount. That's not 2% annually, right? They're giving you a 2% discount for paying it early. So in the case of a 30, you know, standard terms of 30 days, you're paying it 20 days early. So basically, how many 20-day periods are there? So that 2% discount you're taking, what does that work out to as an annual percentage rate? Okay, works out to just over 37%. Okay, so you might run across a question that says the company has to borrow, has to borrow at interest rate of 12%. If in order to pay it early, should they borrow the money? Yeah, because by paying it early, they're actually earning 37%, which is far more than the 12% they have to pay to the bank to borrow the money. Okay. All right. The other thing that I forgot to mention a few minutes ago, but I'll mention now, is on that the average collection period. That basically is telling a company, well, what page is that on? Yeah. So that's basically telling the company how many days of sales they have to finance, right? If they don't have a sufficient cash balance, they're going to have to go to the bank and get financing so they can still pay their employees and pay their rent and all those sorts of things. Okay, so that tells us how much we have to finance in order to keep the company running. So that's an important point there. And if you take managerial accounting, they'll reemphasize those sorts of decisions. That's kind of what the whole managerial accounting course is about. Okay. All right. Now let's go to the moment you've all been waiting for, bank reconciliations. Okay. Oh, by the way, do read through these internal controls of cash. And they do give you a little definition here of cash. Basically, if you go to the bank and say, I'd like to deposit this, please, and they say, okay, then it counts cash. So cash, checks, coins, money orders, drafts from other banks. And then less commonly, you'll see on the balance sheet cash, a line that says something like cash and cash equivalents. Cash equivalents, are these extremely short-term things like money market mutual funds that aren't expected to change except maybe earning some interest. So like stock mutual funds, they go up and down like crazy, right? But money mutual market funds, typically they shoot for what they call a $1 net asset value at the end of each day, $1 per share. And that's what they shoot for. Okay, so it's not so a short-term money market fund would qualify as a cash equivalent because they try to keep it at an even $1 per share. And it's rare that they don't, but it did happen back in the last recession that a couple times some money market funds ended up at like 99 cents per share, 98 cents per share, something like that. They call that breaking the buck. And it's considered very negative for the market. So, and as you know, the market was really crashing back in that era. So, but has done well since then, up until the pandemic here. Okay, now let's take a look at the reconciliation, and I'll just flip through the book's notes here briefly, and then I've got the handout that we'll go through. Okay. All right. Oh, before I do that, I will mention the internal controls. Yeah, so you want to keep a close eye on cash because it does have a nasty habit of disappearing. Okay, so one of the key components of internal control, and internal control is literally controlling, keeping track of things and making sure that our financial statements are correct and or complying with policies, procedures, and applicable laws, all those sorts of things. So how do we ensure that we're safeguarding companies' assets? Well, separation of duties. Okay, separate the person that does accounts receivable from the person that does accounts payable. Okay, that's a real common source of embezzlement. People steal money all the time. It's hardly a week goes by when there's not something in the newspaper about somebody getting busted for embezzling. Soccer moms, all sorts of things, and people that you wouldn't think would need the money. We even had, it's been probably 6 or 7 years ago, at least, maybe longer, campus SRJC campus police officer, believe it or not, was busted for stealing money from the parking meters. So they didn't, it was kind of weird the way the accounting department had it set up. You remember those, or you're probably aware of those parking meters where if you don't have a parking permit, you can go and pay like $3 or $4 a day. So at that time, whoever was collecting the money out of that box could reset it. Okay, so occasionally this guy would go up to one of those boxes, one I guess that doesn't get used very often, and reset it so that there's zero on the counter, the little internal counter that's keeping track of how much money goes in. So he'd reset it to zero, stick the money in his pocket. And then the actual parking meters that you stick quarters in, $1 for them, $1 for me, $1 for them, $1 for me, and he was the only one doing it for years. They were able to confirm that he had stolen about $250,000, but that was really only about 1 or 2 years worth. They think that he actually got away with over $1 million, but they just couldn't prove it because he'd been doing it for so long, and the records didn't go back far enough. So now 2 people have to go and collect the cash out of the meters and those boxes. And also they switched to a more sophisticated system that the box transmits the dollar amount to the accounting department, you know, how much is supposed to be in there. So then they compare, well, how much does the computer say is in there and how much actually got turned in? Okay, so that was a big gap in their internal controls. Standard operating procedure, when there is a lot of cash involved, always have 2 people counting it, verifying it. That way one can narc on the other when one gets busted or whatever. So it's less likely if 2 people have to collude in order to pull off a theft. Okay, so let's talk about reconciling the bank account. Okay, and first of all, what do we mean by reconcile? Well, reconcile means to come to an agreement. You might have heard the term, let's see, 2 celebrities are we're going to get divorced, but they reconciled. You know, it's an agreement, coming together or coming to an agreement, reconciled. Okay. Well, what is it we're trying to reconcile? The balance on our books. Okay. At the end of the month, after we've recorded all of our transactions, you know, for the month, after we've recorded our sales, our cash collections, all those sorts of things. Well, how much cash do we say we have in the bank? Okay. You know, we say we have X amount according to our books. Okay. But the bank says, okay, you may have some other amount. Okay. In this example, I'm going to point out, oh, hang on a second. Again, my screen has disappeared, but there we go. Okay. Let me zoom. Yeah. Okay. Yeah. Here we go. I'll magnify it for you. Okay. So here's their little sample bank statement. It's a little blurry. There we go. That's better. This is the amount that we want. We want the ending balance per bank, and we're going to compare that to the ending balance per book. Okay. A lot of bank statements, you'll see the ending balance at the top, but not always. And in some of the problems you'll run across, you're going to have to look down at the bottom. Also, on the balance per books, in this particular example, they did give you the ending balance per book. So you're just going to look on your general ledger or your trial balance and pick up whatever that cash number is. That's our ending balance per books. Don't pick up the beginning balance. I can't tell you how many students pick up the beginning balance per books and or the beginning balance per the bank statement. Okay, you want the ending balance. That's what we're comparing. The number that they say versus the number that we say. So in their example here, the bank says we have $8,322.20, and we say that we have $9,040. Okay. So who's right? Well, typically neither of those numbers is correct. Okay. That's why we do the reconciliation, so we can nail down the differences. Okay. That's what we mean by reconciling. We're going to go through and figure out what the real number is. Okay. All right. So in their example, they show you a bunch of things. You're going to look at outstanding checks, deposits in transit, bank service charges, NSF checks, interest errors, et cetera, et cetera. I'm going to point out a couple things that they're talking about here on the bank statement. In fact, I'll even zoom in a little bit closer for you. There we go. And I'll let it do its autofocus. Yeah. Okay. Now I realize most of you don't write checks on your, especially on your personal account, but businesses do still write a lot of checks. I know most of you are using debit cards for most of your transactions, and you probably don't bother to reconcile your balance to what the bank says, but you should do that. And I'll give you a little story here in a second. But first, electronic funds transfer, this little thing I highlighted, EFT. So instead of writing a check, you can, as I'm sure you're aware, you can basically do it through your computer. Instead of physically writing a check and mailing it, you just go into the your online banking thing and say, in this case, okay, send $500 to Austin Energy. So it says EFT. Usually there's some sort of serial number after it, so you can trace that specific transaction. Here's another one. We owed $100 to State Farms. Okay, so another electronic funds. Now, this one for $18 says NSF. Okay, not sufficient funds or non-sufficient funds. In other words, it's a so-called rubber check. Okay, rubber check or bounced check. Our customer wrote us a check for $18. We deposited it on our account. And then when our bank sent it to their bank, it bounced or it came back as not sufficient funds. In other words, the customer didn't actually have the full $18. They might have had $17.95, but that doesn't matter. If it can't cover the whole check, it gets returned. Okay. And oftentimes in the real world, we'll typically know that because on a commercial banking account, they'll send you a notice. Oftentimes they'll call you and say, hey, this check bounced. And a lot of times they'll ask you if you want to try to redeposit it just to see if it goes through the second time. But barring that, you may not know until you look at your bank statement that there was an NSF check. So if you're running really close to the bone here where you've got, you're getting down to a few bucks left in your account, you could be bouncing checks because you didn't know about the $18 bounce check. Same thing, see where it says service charge, $6? Okay, that's just the standard monthly service charge. The other thing I should mention, you're probably aware, when there's a bounce check, there's usually a $25, $30 service charge that goes with us, even though you're the victim in this case, because we're the ones that we're collecting the $18, but it bounced. As the depositor, they charge you. And of course, the person who wrote the check, their bank will charge them, $30, $35, something like that. And banks make tons of money off of fees. So yeah, they changed some of those laws a few years ago because debit cards they would routinely allow people to exceed their bank balance on debit card transactions so that they could charge, huge fees like $30 a pop. In fact, I had a student who told me that he used his debit card to buy a malt for like $3. And unbeknownst to him, he said he had subscribed to a magazine or something like that, then canceled the subscription. So they shouldn't be taking the money out of his account, but they did. So he was, getting down to his last few bucks in his account, and that he thought he had in his account, and he charged, he bought this malt and the system let it go through even though he was actually overdrawn. So they charged him $35. So his $3 malt cost him like $38. He did say he was able to beat it eventually because he did get the magazine subscription company to refund his account and say that they charged him an error, but it was a major headache. So do keep an eye on these things. And the other thing I'll tell you, banks do make mistakes. Don't just blindly rely on what the bank tells you. I have seen checks clear for amounts other than what was written. They do have a number of procedures that should stop errors, and for the most part they do. But every once in a while, something happens, something gets slipped through the system. And over the years, it has happened to me several times. I had one situation where, actually, this was in the 80s. My wife and I were getting married, and when you're young and first married, you don't have much money, right? So you're watching the balance in your account very closely. And we were going to go on our honeymoon to Hawaii. Well, we're getting married on Sunday, and I'm balancing my checkbook on like Thursday or Friday, and I discover, hey, they cheated me out of $140, because what had happened was they cleared a check on the last day of one month, and then they cleared that same exact check again for another $140 on the first day of the subsequent month. So they cleared the same check twice. How that can happen, I have no idea. I think somebody was trying to embezzle, assuming people don't check their account balances and reconcile. Okay, so I had to go to the bank, say, hey, you cheated me. And they said, okay, we'll check it out. And I had to call them. They said, call us next week. We'll let you know. So I had to call from Hawaii. And in those days, we didn't have nationwide long distance. It's like $3 a minute or something. So I had to invest like, $10 to call the bank and find out that, yes, I was correct. And they went ahead and added back the $140 to my account. And then more recently, just about a year ago, we have a small rental apartment that we rent out, and it's like $1,300 a month. Well, the guy that's our tenant is an older guy and he's disabled. So sometimes he doesn't pay on time, but we don't sweat it too much because we know he's getting a regular monthly check. But turns out he was in the hospital. So we didn't get, like, let's say it was July. We didn't get the July rent check until like July 25th or something like that. And then we got the August rent check on the 2nd. So my wife went to the bank and deposited both checks at the same time. And then like a week later, we get something in the mail that says, hey, we're taking $1,300 out of your account because you deposited the same check twice. We're going, wait, and my wife goes down there. There's no way. She says, there's 2 different checks. Yeah, it's from the same guy, same bank account number, all that, but different check number. And of course, the signature is not going to be identically the same. And they're saying, no, it's the same check twice. Look, we'll show you. Because if you're not aware of this, checks don't physically go through a check clearing process anymore. They just take images on the computer. They scan them through the computer, and just the dollar amounts, get everything updated that way. So checks don't physically go through the clearing process anymore, but they do keep images of them. So they had fed those through the system. And they're saying, yeah, this check was for the same amount. Well, yeah, they photocopied the same check twice, right? And instead of, one for each of 2 different checks, they photocopied the same one twice and then said, you deposited this twice, so we're taking the $1,300 back. And my wife argued with them till she's blue in the face, and I was at work during the time. So she comes home, says, hey, she explains what happened. So next day, I went down to the bank and I explained to them, hey, I'm talking to the girl at the desk, and she says, well, here, let me show you. She shows me the images. I'm going, okay, now think about it. Your teller would have had to accept the check and a photocopy of that same check for deposit. Do you think that really happened? They're going, no. I said, no. Where do you keep the physical checks? Go back, look through the stack of physical checks, and you'll see it's actually 2 different checks, 2 different check numbers, and the signature is slightly different too. And so they do that up in Santa Rosa. This is at the Petaluma branch. So they do all that at their headquarters in Santa Rosa. So she called up there, talked to the guy that's in charge of that department. He says, well, we'll check it out and get back to you. So I said, okay, thanks. So anyway, they did call back a couple hours later, apologized profusely, and put the $1,300 back in our account. But if we didn't check that and reconcile, and the fact that I had to go into the bank and explain to them what their procedures are, we could have lost out on $1,300. And the other thing I'll point out is sometimes merchants put it through for a different dollar amount than you authorized, or somebody could get a hold of your card, your debit or credit card, and charge you for something. So you really do need to keep a close eye on those and reconcile. Even if you're just using your debit card, don't blindly assume that the bank is always correct, because they do make mistakes. All right, so that's a kind of a long explanation. So let me give you the shorter explanation here. We'll walk through an example. Okay. All right. So let's take a look. I'm going to go ahead and look at the handout here. So the handouts that I put on our class website. So let me make this a little bigger. Yeah. So steps in the bank reconciliation process. And this kind of, this is my Cliff Notes or Reader's Digest version of what the book is telling you. So there's a few steps in the process. Identify the outstanding checks. Now, what the heck do we mean by outstanding checks? My Screen keeps disappearing here. There we go. I think my book is hitting one of the keys on my computer, so that's why my screen keeps disappearing, but hopefully it's not disappearing on your end. Anyway, outstanding checks. No, that doesn't mean it's the employee of the month or won a blue ribbon at the county fair. It just means that we wrote a check, we subtracted it from our bank balance, but it hasn't cleared the bank yet because maybe we wrote the check on the 28th and mailed it to our customer or to our vendor, I should say, and they haven't cashed the check till, first few days of October or something. So, we wrote it in September, but we mailed it out and they don't cash it until October. So that's an outstanding checks because we've taken it off of our books, but it hasn't been subtracted from the bank's numbers. Okay. And so that's one of the key reasons, timing differences. So in the book example, again, 8322 is what the bank says, and we say it's 9040, right? So timing differences, that's a huge thing. Okay. All right. So that's outstanding checks. And the process to identify all of them can be tedious. If you're working for any sizable company at all, you'll probably have a number of outstanding checks. So you have to go through on your books. Typically, companies will have some sort of cash payments ledger, subsidiary journal, et cetera, et cetera. So a record of all the checks you wrote. So you got to go through your records of all the checks you wrote and compare those to the bank statement. So we'll go through and we'll put little check marks. Okay, this check cleared, this check cleared, this check cleared. So then we'll get down to the last few checks we wrote at the end of the month and we don't see them on the bank statement. So those are the outstanding checks. So you got to tally up how much those add up to and subtract those from the bank's balance because they've already been subtracted from our book balance, right? So subtract them from the bank balance. Similar thing on the so-called deposits in transit or outstanding deposits. If you go into the bank, you might notice there's a little sign on the desk that says deposits made after, say, 4:30 will be posted the next banking day. Well, if you went on September 30th at 4:45 and deposited $100, that's going to be on our books. We're going to record that because on our books, we made the deposit on September 30th, but the bank says, oh, not so fast. You didn't deposit it before 4:30, so we're not going to give you credit till October 1st. So that $100 is going to be a deposit in transit. So we'll have to add that to the bank's balance in order to reconcile our numbers, okay? Then I say analyze the bank statement for items not recorded on your books, which we just looked at a couple of examples there, bounce checks, service charges. Depending on your account, you might earn a little bit of interest on the account. I do say notes collected here. That's not real common, but in some cases, customer might send his payment check directly to your account at the bank without running through the accounting office first. So you have to double check for those. Okay. All right. So these items will require journal entries. Analyze the bank statement. So these items will require journal entries. Okay. Then check for errors. They do give you an example in the book. There's a $9 error. They took out, they wrote a check for $100, but recorded it on their books as 109. So we'd have to add back $9. That gets a little confusing. They do show you here. Yeah, this is page 310. They're adding back the $9 because they took out $9 too much. It's almost kind of seems counterintuitive, but think about it. On our books, we physically wrote the check and it cleared the bank for the $100. The verbiage is down here at the bottom of the page. But we took it off of our books at 109. So we've taken out $9 too much. So we have to add that back. That's another thing that confuses students quite a bit is, the effect of errors. Okay, so be careful with that. All right. Let's see, check for errors, bank errors. Yeah. Sometimes you'll see something that says something along the lines of and this does happen, a check written off some totally unrelated company's account gets cleared against our account. Okay, how that can happen, I don't know, but it apparently does. So bank errors such as processing another firm's check against your account. That doesn't require a journal entry because our books are correct. We didn't account for that check because we didn't write it in the first place, but the bank has subtracted it from our account. So it's easy to go through and crunch all the numbers and get it to balance, but don't forget, call the bank and tell them, hey, you took $8,000 out of our account for this check that has nothing to do with us. So put the money back in the account. So and they'll double check and make sure everything's legit and give you the money back. But do check those. Okay. And then, prepare the reconciliation. Okay. So let's take a look at the form. I call this Brecht's patented method of bank reconciliation. Okay. So now the form that I gave you, a couple of things here. I'll zoom out a little bit so we can see more of it, but now balance, I've got balance per books in the top section here. And then notice I say ending, and then balance per bank statement on the lower section down here, ending. Okay, just a reminder, we're comparing our ending bank balance on our books to the ending bank statement amount on the bank statement. Okay, not the beginning. Okay. Notice on our balance per books here, I've got a couple things, a little asterisk next to each of these. Okay, credits. So we're going to add back. So we'll put our balance for books, then we'll analyze the bank statement, add back any interest that they posted to us, any notes collected, etc. So we'll add those. Then we're going to subtract out service charges. Okay, service charges, bounce checks, anything along those lines. So subtract those out. And if I can, there we go. Okay. And then notice I've got, it's a little hard to read, plus or minus any errors. Okay, because they can go either way. That $9 example I gave you, that we could have not taken, we could have actually, maybe the check was actually for 109 and we recorded it for 100. In that case, we'd have to subtract $9. Okay, so those get real confusing, so be careful to understand those. The little asterisk says down here, journal entries required. Okay, so these changes that we're making to our balance per books all require journal entries. Okay. These down here on the bank statement side do not require journal entries, but they may require us to contact the bank to make them aware of their error. Okay. The other thing is this form is not carved in stone. A lot of times if you look at your bank, if you get a physical bank statement in the mail, I know most of you don't, but there's probably somewhere on their website that they've got, how to do a bank reconciliation. They've got a form laid out there for you that's basically like this, but it might be, balance per bank on the left and balance per books on the right. Or if it's a vertical format, it could easily be the balance per bank up here and then the balance per books down lower. So it's not carved in stone. Okay. And typically in the real world, we'll do this on an Excel spreadsheet and, have a template set up so we can just do this month after month after month. Okay. So in their case, I'm going to point out the numbers here in the textbook, and then we'll take a quick look at an exercise. Okay. All right, so here's the journal entries they came up with. Yeah, they earned some interest, so they debited cash, 20 bucks, credited interest income. This 18 bucks for the bounce check, notice they're debiting accounts receivable. They're not debiting bad debt expense because we're still going to try to collect it. It may be collectible, so it may end up being bad debt expense, but we'll have to decide that down the road. So initially, we'll try to collect it. So the person that was a cash customer is now an accounts receivable customer. So we'll be sending them notices, calling them, et cetera, et cetera. So we're debiting AR / customer name and then crediting cash. Okay. Then here's the bank service charge. We, debit bank service charge expense and credit cash. And then here's the, let's see, to record service fees. Okay, then debit cash, credit accounts payable, because we took too much money out. So when we wrote that check, we debited AP. So we took $9 too much out. Okay, so we got to increase the liability. So increase cash and increase AP. Okay. Yeah, so those are typically fairly typical journal entries, okay, that you'll see. Okay, and again, I've got the little asterisk here to remind you to record those journal entries. Oh, the other thing I'll mention, yeah, you could do some sort of giant compound entry, because notice there's a bunch of debits and credits to cash here. So you could do a compound entry, but it's actually less confusing just to keep them separate. Especially a lot of times we'll have to go back 2 or 3 months and look at previous checks outstanding and all sorts of things. And why did we do this entry, et cetera, et cetera. So it's a lot easier to follow and reconstruct what happened in earlier periods if you do separate, distinct journal entries for all of these instead of making it into one big compound entry. Okay. All right. So that's kind of a lengthy explanation. Let's take a look at exercise 6-27 on page 327. We'll walk through this together. Okay, a fairly simple, fairly straightforward example. But I think it's worth walking through together so that we make sure that you have the right idea here. Okay. All right, so again, page 327, exercise 6-27. So Bentley Company's June 30th bank statement and June ledger account for cash are summarized below. Okay, now here's one of the hooks they throw you on a lot of these problems. They don't give you the ending balance on your books. Okay, that's right here. Yeah, so sometimes they don't give you the ending balance on your books. You have to figure that out. Okay, so they show us the T account. We had a debit balance of 6,500. We made deposits of 18,100, and we wrote checks for 19,000. That gives us an ending balance. So this plus this minus this gives us an ending balance of 5,600 in our cash account. So that's the number we want on our balance per books, ending balance per books, 5,600. Okay. Let's see. So that's pretty straightforward. Now, most of these problems, they'll just tell you what how many checks were outstanding. But I will make a note here. Compare checks written to checks cleared. Okay. 19,000 is what we wrote, and that's on our books. They say only 16,600 cleared. So that is a difference of 2,400. And that's what they show us. A comparison of the checks written with the checks that have cleared the bank show outstanding checks of 2,400. Okay. Now, I'll just mention a slight complication that you might see. There might be checks cleared during June, 16,600, but one check from the end of May for $100 is included in that 16,600. So really only 16,500 of checks written in June were cleared. So in that case, we'd have 2,500 of checks outstanding. Okay, so be careful. You will run across a couple of problems that say that. So usually they'll just give you the number of checks cleared in the month, but sometimes they'll give you that included X amount from the prior month. So be sure to account for that. Okay, because that means the checks you wrote for the month, less of them have cleared, so you have more outstanding. Okay, anyway, that's a long way of saying we have $2,400 of checks outstanding. Okay, and that's balance per bank statement number. Okay, outstanding checks 2,400. I'm going to put parentheses around it or the pointed brackets so we remember to subtract that. Also, I should have gone ahead and dropped in our ending balance per bank here on our bank statement side. Okay, so the bank statement says we have 6,060 in our account. Okay, so 6,060 versus 5,600. Who's correct? Well, we'll find out. All right. Let's see. Oh, a deposit of 1,900 is in transit at the end of June. Okay. Let's see. Yeah, so we can check that on our books. We say we made deposits of 18,100, and they say we only deposited 16,200, difference of 1,900. So we're going to add that to the bank's numbers. Okay, so we're going to add 1,900 for deposits in transit because they didn't give us credit on their books, but we've already added it to our books, so we don't need to adjust our side. Okay. Let's see. Give any journal entries. What is the balance of the cash account? What is the total amount of cash should be reported on the balance sheet? So now let's look through. Let's see. So we're going to take a look on our bank statement, see if there's anything that we don't know about. It says, again, it's mostly timing differences usually that we're accounting for. And I guess the one trick I could say to this whole thing is ask yourself, who knows about the transaction and who doesn't? Okay, the party that doesn't know, isn't aware of that particular item, has to have their numbers adjusted. Okay, so we're going to assume in this case, well, we didn't know there's a $40 service charge until we open the bank statement. Okay, so here I'm going to subtract $40. 40. Okay. And I don't see anything else on the bank statement that we should have to account for. So let's just see what happens here. So 5,600 less 40, 5,560. If my mental arithmetic is working correctly. And then, yeah, I think we're good here too. 6,060. My mental math says yes, but I'll add it. 6,060 plus 1,900 minus 2,400. Bingo, 5560. 5560. And cha-ching, right? Okay, we got it to balance. Okay. We do in fact reconcile 5560, but we got to remember to go back and do this journal entry. Otherwise we'll be off next month by this 40 bucks. Okay. So, you know, debit bank service charges and credit cash for $40. Okay. That's a relatively simple example, but the book's example is fairly involved. So make sure you work several of these. And because there will be a fair number of points available. Okay. On the next exam. Okay. All right. Let's see. Oh, just as a little side note, notice I've got a little thumbs up here. So you're going to do an Excel problem. You're going to do problem 6-5 and submit it on Excel. And I set up a template that's almost identical to this. Okay. For you to record, you know, do the reconciliation on. So problem 6-5. The little thumbs up, you'll get the thumbs up thing if it balances, okay? Because I set up a little if statement in there. If you're familiar with a type of font called Wingdings, and what that is instead of numbers and letters, it's converted all those numbers and letters to different symbols. So a guy that worked for me years ago came up with this idea. So if you put in this little if statement and if it balances, it gives you a thumbs up. If it doesn't balance, it gives you the skull and crossbones. Okay. So when you first fire up that template, you'll see that skull and crossbones, but once you get it to balance, it'll switch to the thumbs up symbol. So you know you're in balance. Okay. So, you know, fun with accounting. You want to have more fun in the office. Someone's not looking, they go to lunch, you switch their mouse to a left-handed mouse, which reverses the operations of the click, you know, the buttons to click. So anyway, so yeah, so that is 6-27. And again, you're going to do 6-5. I already have that in the module for you to do. Okay. All right. Let's see. I think that's everything we need to cover, but let me just double check. And let's see. Discount formula. Yeah. Sales returns. Bad debt. Okay. Yeah, that is basically the chapter in a nutshell. So be sure to read it thoroughly. Read the notes I've posted for you on our class website, and I will see you next week. Have a great day.